So UK house prices have just passed the £300,000 mark on average for the first time ever. But this does not mean the whole market is booming. Depending on where you invest, the market could either make or cost you hundreds of thousands over the next few years. So in today's presentation, I'm going to break down what's actually happened in the UK property market for 2026. So let's get into it. The average UK house price has crossed £300,000. This figure is heavily skewed by London and South East, but when you remove these areas, many regions are far, far lower, yeah, while others are growing faster. So property is not a national market. It's thousands of local markets, And I always talk about building your own little property property world within your own portfolio. And I've seen my portfolio grow in capital growth, more so with the properties that I've got down south, highly in capital growth. But the properties that I've got up north have also grown, but not as much. But it's nice, steady growth. It's good, much better return on my investments up north. So, for me, the key is always to get that balance of, capital growth and good return on investment in your portfolio. So Northern England and parts of the Midlands are leading the growth right now. London and South East are flatter due to affordability pressures, which I've spoke about many times over the last year to year and a half on this channel, that this was going to happen. Doesn't make London bad, it just means strategy really matters now. So return on investment and capital growth behave differently in different regions. So this is something to really start thinking about, The Midlands and Northern England are right now the most desirable places to invest, and lots of investors are looking in these areas. So confidence is quietly returning. Inflation has eased off, wages have stabilized, and buyers now believe that the worst has passed. So confidence is coming back into the property market, which is a really good sign, Another good thing is mortgage rates are no longer rising aggressively. So they're steadying out, stabilizing as well. So when people are looking at the market, looking at, their borrowing price, what I mean by borrowing price is their interest rate, on the money that they're borrowing to get mortgages, it's stabilizing, at the moment. So the markets move on sentiment before fundamentals fully improve. So these little things, confidence coming back in, mortgage rates stabilizing, it's all good signs for the UK property market, And the thing is, this is not a boom market. It's a selective market where disciplined investors will always win. So focus is always, for me, as a property investor in buy-to-lets, the focus should always be on rental demand, sensible pricing, and the fundamentals of normal boring vanilla buy-to-lets. That's where the focus is right now, and that's where it should be. Below market value deals matter more than speculation. Below market value means, if you don't understand what that means, is that, the market value of a property is, for example, £100,000, but you have invested in your education and learned negotiating skills to get that property for, let's say, £80,000. There's lots of them out there, and getting property deals below market value means that you're buying equity, which is fantastic. Common mistakes. One of the biggest mistakes, where investors are getting so wrong at the moment is people are waiting for a crash that may never come. Because and the reason why I say that is because supply is restricted, so the demand remains really, really strong. That doesn't indicate a crash to me. And another mistake is chasing the old hotspots instead of the new hotspots, So again, when I talk about hotspots, I'm talking about areas that are up and coming that have really good entry prices for buy-to-lets. But in 10 years' time, they're going to be maybe the same sort of price as London prices are now, So that's what I mean by hotspots. And spotting them and picking them out isn't as hard as it sounds, as long as that you're doing your research and you're invested in your education, you're networking with people, you go into different areas, you're talking to different people that in different areas, and you soon start to realize where the hotspots really are, So I would say smart investors buy before confidence fully returns or enters an area. A lot of people back in the day was talking about Manchester being a hotspot, for example. That's come and gone, sort of thing. Now Manchester prices are rising crazily rapidly, and you probably look back and think, oh, I really wish I jumped on that train, But there's plenty more of them, like Manchester, Liverpool. There's plenty more of them out there, So my final thoughts for now on the UK property market 2026, it's about being a little bit more precise and not jumping on the hype. Yeah? So if you understand the cycle, there's loads and loads and loads of excellent opportunities still out there, and that will constantly be out there for you. In my next video coming up, I'm going to talk about 95% mortgages and the impact that it's going to have on the property market. 95% mortgages are obviously for your first-time buyers, which it's good. It's even good for investors, but it's an indication for investors as well that you've got to start moving soon, because the 95% mortgages that they're offering, quite a few different lenders are offering it now, means that your first-time buyers who are currently renting are going to see an opportunity and affordability to get themselves on the property market, get themselves on the property ladder. So something to really, really think about. And I'm going to cover it in tomorrow's video, 95% mortgages. Again, really hope you've enjoyed today's video. I've been Craig Parker as always. Don't forget to like, share, comment, and subscribe. I'll see you again next time.